Looks like everybody is being added in. Okay, should be most people. Good afternoon, everybody, and welcome to a very happy holiday edition of the monthly market breakdown with Real Estate Magazine. I'm Courtney Zwicker, associate editor with Real Estate Magazine, and Daniel Foch of Valerie Real Estate, who's going to be taking us through a presentation, and we're going to be going through it and giving a little overview of how things are looking across the country.
Awesome. Thanks, Courtney. As you can tell, everyone, this is a very serious episode of our a monthly market call. I'm calling this one either the 12 charts of Christmas or maybe the crystal ball sort of outlook for the new year. So I'm just going to share my screen here real quick and we'll just get right into it. If anybody has questions, feel free to put them in the chat and then Courtney can fire them off to me and just interrupt me. That's totally fine. I would rather this be a conversation than a presentation. So if I'm not explaining anything properly or you want me to go deeper on something, just let me know. All right, let's get into it. So the couple of things I'm going to cover today, mostly CMHC report and then Q3 population data. I didn't put much on unemployment and inflation just because they haven't changed a ton on a month over month basis. So I figured it wasn't a huge theme heading into the new year. Can talk quite a bit about mortgage renewals because we know we are hitting the biggest portion of the renewal wall next year. And then I'm also going to talk about vacancy rates, first-time homebuyers a little bit, and the Equifax report, which shows that Canadians actually hit a record level of household indebtedness, which is a little bit unfortunate, but we'll talk about what that means. So the the overall themes that I think we want to think about for the year over last year, and then also heading into next year, is that most of the things that are rising are things that you wouldn't want to see rise. We have vacancy rates going up, so this is putting a lot of pressure on investors and changes their financial models, or should at least. And I think it's important that investors are using the right data. So I'm going to talk about what that is. Housing supply is going up, although there is evidence that that could taper off. And I'm going to talk about there's kind of conflicting metrics from different reporting houses and then also different types of supply. So you hear that the condo market's tapering off in Toronto, but the rental market, we're building record levels of supply right now. Housing starts are rising, but they are expected to slow down over the next 2 years. Building permits are going up. So building permits are interesting because a building permit would happen before you do a housing start. And so if a builder's thinking about building something, they might pull a building permit and then they might later change their mind and just not exercise the permit or not build it. But as it stands, there's a record level of, not a record, sorry, but we're sort of at record levels or sort of in that record channel of building permits that the total value of building permits that could come on the market. So you have a lot of pent up supply or supply that's sort of waiting in the wing. And what happens with that, the fate of that really will determine the path that the housing market goes, I think, over the next couple of years. I'm of the opinion that builders are becoming increasingly disincentivized to bring supply on the market because of some of the factors that I've mentioned. Rates are high, rents are going down, vacancies are going up. Those are really the three big things. And the one that builders, at least if they're building mostly rental, are most sensitive to is actually interest rates. If you think about if interest rates, if you're building on a CMHC MLI Select mortgage, and you're on a 50-year amortization, your first couple years of mortgage payments, you're like 70 to 80% of your monthly payment is interest. And so if 3/4 of your monthly payment is interest and your interest rate is 5% rather than 4%, because the Canada 5-year bond yield is 100 basis points higher than we thought it was going to be when we forecasted our projects, that is the most likely factor that's going to kill a lot of this rental supply. And so rates are the biggest thing that I'm paying attention to right now. Vacancy matters, rents matter, but they don't matter as much to these landlords who are bringing purpose-built rental supply on the market. as rates matter. So we'll talk a little bit about that. Delinquencies are rising, but they're also kind of falling. And I'm going to talk about that. It's sort of like a tale of two different types of lenders, and there's three. I have sort of have three theses on why that's happening. Um, the Canadian debt load is rising. First-time homebuyer activity is actually rising. That's probably the one bright spot for those of you who are watching. A couple of other bright spots, I guess, MIC delinquencies are falling, and that's one of the things I'm going to talk quite a bit about in today's episode. And I have a YouTube video coming out on this probably between now and Christmas. I've already recorded it. I'm just sort of in editing. Population is falling, and it's falling at the fastest rate that we've ever seen. Um, Rents are falling, but also the cost structure is falling, and this is a really important piece of the puzzle when it comes back to those building permits. Is if we see changes to development charges or construction costs coming down or land costs coming down, that could actually re-incentivize a lot of that supply, that pent-up supply to come on the market next year, and we could continue seeing a lot of supply hit the market in Canada, new supply hit the market in Canada. Any questions? No?
Nope, not yet.
Okay. Um, so one of the most interesting things, there's a lot of charts that look like this right now. Okay. And like this, it's sort of like you're kind of in a normal channel, and then you see this record number of Canadian bank loans for real estate development. And everybody would say like, well, I thought we're past the number of, we're past the peak of housing construction. Yes and no. So historically, a lot of these projects would be not done by chartered banks. They'd be done by sort of like alt lenders, kind of like your King Sets of the world, like your alt A lenders. Equitable, Laurentian, I guess, is a chartered bank, but they have a great construction program. But like your big six banks would play in that space if it's a syndicated loan, but they weren't doing a ton of it. But then CMHC MLI Select happened, and it insured away a lot of the risk. And so what you're seeing on this chart is Canadian banks have record exposure to the construction industry in the existing condos that are under construction, plus in a lot of these insured CMHC MLI Select loans that they're now playing in because it's way less risk for them to get exposure to construction. The this has sort of led us to the point where we are at record rental construction in Canada. And when you look at the rental market share of total construction, I've shared this chart a couple of times, so I'm not going to go too deep on it, but I just want you to sort of understand the outcomes of what's happening is we're building more rental than we ever have. So for real estate professionals, I've mentioned this, I think in the last call, it was really about how agents are moving towards becoming rental agents. And this is a theme that I think is going to be a key theme in 2026. I don't necessarily think it's a bad thing, but I think it's something that's really worth paying attention to. And I don't think enough people are paying attention to it right now. One of the big reasons why the rental market is so active is because it's becoming a more affordable housing tenure faster than homeownership. So homeownership is improving, but it's not improving enough and fast enough. Like we saw that big steep drop, and then your rates were going up, and so big steep drop in prices, rates were going up, and I'm talking generally, sort of at a national level, and it corrected housing affordability quickly, but rates sort of offset a lot of that price gain that you would have got. Now you're getting rates coming down, and prices have been sort of sticky. They're still grinding down a little bit, but they're not moving down with the same velocity that they were before. And rents are able to fall like in some areas, we're seeing rents down like 10% year over year, 15% year over year. And so rents are actually creating affordability quicker than house prices. And so this is why we're seeing a lot more velocity. You're seeing way more people just choose to be tenants, just elect to be tenants because it's the better financial move. And it would vary on a city by city basis. In last month or 2 months ago, I showed a couple of different cities and the spread between renting and owning. In Toronto and Vancouver, the cost of owning is way higher on a monthly basis, way higher than the cost of renting. In a city like Edmonton, Calgary, or Ottawa, that spread is really small. And so there isn't a huge incentive for somebody to rent rather than own. If they have a down payment saved, they might as well own. And so you're seeing activity steady in those markets. Ottawa, if anything, is actually like kind of in a slower like recovery or like a flat kind of bottom. It's not in that grind down. Montreal might be the outlier in this regard, where it's still like sort of, it kind of seems to be plateauing, but it does have some affordability, but it still has a gap between the cost of renting and owning. So the reason that rents are falling, this is from CMHC's most recent rental market report, by the way. I would highly encourage you to check it out. You can basically just Google CMHC rental market report, fall rental market report, and you can interact with all of these charts. And this is really good stuff if you represent investor clients and you want to give them good data points for their underwriting, right? Like your your investment is really only as good as your model. And if you're putting bad inputs in your model, then you're going to have probably a bad output. You need to be forecasting proper vacancy, proper rent growth. And right now, vacancy is going up and it's higher than a lot of people are forecasting. I look at hundreds of these pro formas a day. Everyone's trying to peddle me CMHC MLI Select projects in Alberta so I can promote them on the podcast. And none of them are underwriting with a real market vacancy or an increasing vacancy or falling rents. So you want to make sure that you're putting the right inputs into your model. And if the deal still survives the now bad inputs that we have, which is rents falling and vacancies rising, then it probably is still a good deal. If it doesn't, and most don't, then it's probably not a good deal, or it's at least too high risk for an investor, for a position for an investor to be taking in a market like this. One of the big reasons why rents are we're seeing a suppressed rental demand is we're not really seeing a lot of population growth. Obviously, organic, but then also we're seeing a decreasing population growth of basically young people. A lot of your temporary foreign workers, non-permanent residents, international students, those are all actually leaving the country on a net basis. I'll get to some other charts on that because StatCan's Q3 data came out in just a couple of days ago, and I think about 6 days ago, and it was pretty shocking, honestly. And I think it's going to continue to shock. I think that that curve is actually going to continue moving down through the next year. But I'll show you that chart as we get there. But the ones that you really want to pay attention to, Ontario and Alberta have seen the biggest outflow of people. Sorry, Ontario and BC, and Alberta has been the biggest net beneficiary. If you look at Quebec, so we're just looking at the pink bars here. Quebec barely saw any growth. Nova Scotia barely saw any growth after coming off of a record year, and Quebec coming off of a record year as well. Alberta is coming off of a record year as well, but they are still seeing growth of about 2%. Their population growth of this is just population growth of young people was at 7% last year. Alberta's population was growing like it grew like 4%, I think, last year and 11% the year prior. It was literally the fastest growing place on earth for a period of time. If you look at like sub-sovereign states, that's sort of coming to an end, and we're seeing that demand kind of plateau. And this is a very similar story across most of Canada. Ontario and BC definitely feel the emigration and slowdown in population growth first, but they don't feel it the most severely. You feel it the most because eventually and if their prices become affordable, more people end up actually going to those places because that's where most migration is. Economic hubs of the country, and then it sort of spills out into other places thereafter. The places that feel it the most, Halifax would probably be one of the biggest ones. They really ride that immigration curve. They have a lot of post-secondary institutions. They have a really high number of young people. So Atlantic Canada and then Alberta probably will eventually feel it as well. The prairies, Manitoba and Saskatchewan are also feeling their growth sort of taper off. They're just not shown on CMHC's chart. Jumping over to Vancouver from CMHC's report, the condo, like the hard part about looking at the rental market is we don't even really know how much rental supply actually comes from condos. And so when people look at the condo curve in Toronto, they'll say, "Oh, well, we have the condo supply is actually going to drop right off, or the condo supply in Vancouver is going to drop right off." Well, it's going to be backfilled by purpose-built rental. Maybe not entirely. You're starting, but I think we have about 21,000 projects in the pipeline now that have units, sorry, that have in Toronto that have pivoted to purpose-built rental rather than condo as their termination. That's what you would call kind of like the how they realize their revenue. So they would terminate by selling condos, or they would terminate by holding it or selling it as a rental building. In Vancouver, we're basically seeing record record condo supply hit the market while the rest of the country is seeing record rental supply under construction. Toronto's the same thing. I think we talked about this last time, and somebody had asked a question about, Urban Nation was reporting 30,000, 38,000 closings in 2025 and 20 something thousand in 2026. I'm of the opinion that 25 is going to shrink. Like we'll see in hindsight that 25 actually saw less closings because builders aren't eager to close right now. They're hoping that rates can get better. They're hoping the economy can recover a little bit. They're hoping that buyers can figure out a way to actually take possession of these units, shuffle some money around because like you're running a huge failure rate right now. Buyers are failing at about 20%, 20 to 25%. I think 22% was our last reading. So on closing day, 22% of your purchasers are actually showing up and saying, I can't buy this. You can keep my deposit, sue me if you have to, but I don't have the money to take possession. And so they're trying to mitigate that a little bit by kind of pushing the closings out. The other reason they might be incentivized to do that is we're actually seeing improvements in the cost structure. And a lot of these costs are fixed because it goes through a bidding process. So they maybe can't necessarily realize that, but they're going to try. Jumping over to Calgary here. Again, this is all from CMHC's report. So I'm kind of just putting all the charts that they have out here. Calgary's rental market is considered generally steady. There are some interesting gaps in it between old supply and new supply, which I'm going to get to. But basically, you've seen this huge growth in the purpose-built rental apartment universe. You can see basically 2025, they built 11% of their supply. So if we go back, we say 2024, their population grew by 11%. If all of those people were renters, in 2025, they built 11% of their rental supply. So the one thing that I'll say about Alberta, and this is why it's a much harder market to trade than Ontario, is they're incredibly efficient at meeting demand. They don't have as much red tape. They don't have development charges to the same extent. They don't have land transfer tax to the same extent. They don't have provincial services tax to the same extent. They don't have green belts, right? They allow for sprawl, et cetera. And so this makes it a lot easier for the markets, and most of your prairie markets would be similar to this. Makes it a lot easier for those markets to bring supply to the market to meet the huge demand that they're seeing.
Just looking at the red dotted line there,
Yeah.
one thing that I've been thinking about for a couple months now is is the cost of living getting any closer in relation to incomes? And that's interesting to see that the rent to income ratio is starting to take a little dip down. Would that suggest that incomes and the cost of living are starting to get more closely aligned?
Yeah, so basically in Alberta, you're seeing wage growth. Like they do have a pretty high unemployment rate, but one of the things that Alberta has that Ontario and BC especially don't have, and especially your Toronto and Vancouver, is they have exceptionally high wages. This is why CMHC MLI Select projects work so well in Alberta, and this is probably why a lot of these projects in 24 and 25 are actually riding that curve down, is because you can't build a project if you're not putting some portion of affordable units on the market. And so I guess you could, but most people wouldn't. And in Calgary and Edmonton, your local or median household income, which is what CMHE uses to measure the term affordable, is pretty high. And so your developers are incentivized to do 10, 20, or 30% of their units as affordable rentals to get higher loan to value, better interest rates, and longer amortizations. So yeah, I think that your supply is definitely pushing that curve down. When it comes to like the overall broader basket, yes, nobody believes me when I say this, but yes, cost of living it's not getting better. Like you have cumulative inflation of like 15 to 20%, not even more than that, right? Like if you look at food, I ran the numbers on like a cost of a Christmas dinner in like 2015 versus today, and it's literally double, right? So if you look at like your Christmas dinner index, this is where people are saying, well, inflation is not coming down because prices aren't coming down. Well, inflation still means that, like, you think about you're blowing up a balloon, it's still, if you're inflating it, it's still filling, right? It's still growing. It just, if you're inflating it slower, if your inflation rate is coming down, then that means it's still growing. The balloon is still growing. You're just not putting as much air into it, right? And as you start to fill that balloon with more air, it gets harder to fill it because there's air pressure coming back at you. It's very, very similar analogy is why inflation is such a great term. The term that people think they're talking about when they hear inflation is falling is deflation, but we're not seeing deflation. We're seeing disinflation, which means we're still inflating, but at a lower rate. Deflating would be actually letting air out of the balloon, right? Disinflation just means I'm filling it slower.
Heaven forbid we let any air out of the balloon.
I know, yeah. Well, I mean, the problem with, and you can see this in the housing market, this is an exceptional example, right? So the problem with deflation, I have no problem with deflation personally, and I think Canada desperately needs it. But the problem with deflation is central bankers are afraid of deflation because Canadians have a really high what's called an inflation psychology. So if we think the market's going to inflate, we buy stuff now to front run those price increases because we have such a debt based economy that we can always just take debt and buy the thing. And that begets more inflation. But the same thing is true to the downside. If house prices are falling, and I'm a buyer and I've seen house prices falling now for 2 years in a row, why would I buy a house, right? I'm really only going to buy a house if I'm concerned that I'm going to be losing purchasing power against the value of that home. And that's not the case right now. Right now, the buyers are basically saying, I'm just going to keep waiting because I've been rewarded for waiting so far. And so deflation begets more deflation because if you see prices of houses or TVs or your Christmas dinner falling, you're like, I'm just not going to buy this thing. I'm just going to wait because as far as I can tell, I'm going to keep getting a better price every time I go back to the store. Um, okay. So this is a really interesting chart. This is just a breakdown, a cross section of Ontario, but you can see this trend carried across the country. And it shows from CMHC that higher vacancy rates are in the mostly in the neighborhoods that contain at least one post-secondary institution, with Brampton really being the biggest jump that we've seen, but Mississauga as well. So Brampton, for those of you outside of Ontario who weren't familiar, basically Brampton, a lot of the satellite colleges or satellite college campuses were set up in like strip malls and stuff like that. So like a college in like Northern Ontario would partner with like Stanford College is like the famous like joke one because it's like named Stanford and there's a picture of it in a strip mall. Um, they would partner with one of these like local strip mall colleges and they would be able to get a bunch of international students. Most of the international students, our biggest cohort of international students comes from India, and Brampton's a very popular place for people from the Indian subcontinent to live. And so that's sort of how those things aligned. And so that's why Brampton saw basically the biggest jump in vacancy rate because um, we have to remember we're not in phase one of population growth declining. We're in phase three, right? Like phase one happened early 2024. And I remember saying you could see the international student population rolling over organically because, you were starting to see all these TikToks of international students basically putting word out to back home saying, hey, this is fake news. This was a scam, don't come here or whatever. And then what happened was the government said, oh, we can see this number rolling over. Maybe I'm being too conspiratorial, but I think that, if anything, I'm giving them credit for being smart. Um, they could see that number rolling over in their data before it was published. And they said, we're going to put a foreign buyer ban out so that we can take credit for a lot of this organic trend. And then we saw the number of temporary foreign workers be reduced shortly after that in Q4 of 2024. So those are over a year old. And we're just seeing the lagging impact of that now as those student visas expire. A lot of them are getting post graduation work permits. And we're seeing the number of international students reduce significantly. The rejection rate is the highest that it's ever been as well. So that is what's causing this. And you can see this in institutions all across Canada. But the key is you want to look at the ones that saw the biggest increase in international student enrollment. And I've shown this chart a couple of times in the reports. So, but if you just Google 240% international students on Google, they'll get a Reddit result. And that's a chart from Mike Moffat that shows like Canadore College, Conestoga, et cetera. They all increased their international student enrollment by like 4,000%, 6,000% in some cases. And those are the markets where you're really feeling it. Kitchener-Waterloo, I would say you're definitely feeling the pinch on international students. You're not seeing it so much in like your U of T's, et cetera, because what happens is because they're changing the quantity of international students, it also has a quality effect. And what it means is, I mean, now international student, they used to only have to have $30,000 proof of funds. Now they have to have $60,000 proof of funds. In some cases up to 120,000, depending on what they're studying. And so you're getting people from wealthier families. You're getting people who aren't trying to game the system and being sold a false dream of getting a postgraduate work permit. The rules have been made a lot clearer. They've really clamped down on the fraud that's being committed against these international students. And now that means that your higher quality institutions are actually seeing an relative increase in enrollment compared to your, I don't want to call them lower quality institutions, but the institutions that weren't, I guess I would call them lower quality institutions. The institutions that were selling like fake degrees and becoming degree mills and using this to try and exploit the capital they could get from international students, which was 3x the tuition than a domestic student, as well as sort of the lack of knowledge that they had of how our system worked. So spent more time on that one than I intended to, but I think it's an important thing for people to think about. And I think, especially for a lot of young people who are in the real estate profession, you would touch and feel this on a regular basis because we're working with a lot of young people, many of whom are coming from those streams. One of the things I would encourage you to understand is that right now our permanent resident number isn't falling that much. They're trying to cap it at 38,000, or sorry, 380,000 for next year. But 50% of those, I wish I put the chart in here. I should have. I'll see if I can bring it up when we're doing the questions. 50% of um, the uh, this would be your technical immigrants, so your permanent residents, are actually coming from within Canada. So it is people who already were on a different type of visa. Maybe they were international students, maybe they were temporary foreign workers, et cetera, and they did successfully make that step up. And so that's a really important piece of the puzzle to understand is there is probably a lot of demand for people who were in some sort of temporary format in Canada. 50% of your 380,000, so like almost 200,000 people are in Canada and they're now becoming permanent residents. And that changes the way that they consume housing, right? If you're a temporary foreign worker or temporary or international student, you're probably not going to buy a house. It doesn't make sense because you don't know, you have no certainty on how long you're going to be here. If you go to, you're now a permanent resident, you're probably going to start planting roots. You're going to think about buying a house, et cetera. And so there is demand that will come from that. Sorry, I mentioned this chart. Vacancy rates in this is in the Ottawa CMA, but this tracks on like Alberta. I've used the chart in Alberta. It showed the jump in vacancies from brand new built units. If a unit was built, so the newer a unit is, the higher the vacancy level is for that building. And the reason for this is there's a couple of different reasons, but the biggest reason is the more new something is, the more expensive it is, and it's not just like a new car or whatever. It's also new inputs. So like construction costs were rising, et cetera. If you look at all, so this is your units built through since 2015, the vacancy rates are higher, and the highest that they've been in a long time, almost 7% in Ottawa. And then if you go to all units, your vacancy rate's pretty normal, 3%. And so the more expensive units are having a hard time clearing in the market. And if you can see this in like, for those of you who are in Toronto, you go show a client a bunch of rental units, condo units, and then they say, oh, well, what about this building? And it's a purpose-built rental building, and they can rent a two-bedroom condo for, I don't know, whatever, $2,600, and yet the two-bedroom purpose-built rental is $3,200. And it's just because these are the rents that these developers need to achieve to make the project economics work. And there is almost this like weird thing that's happening right now. I don't know if I mentioned this on the last call, but the way that we're seeing it happen is like the purpose-built rental projects are actually willing to accept tenants with lower or less verifiable income, less quality income, maybe less lower credit scores, et cetera. And so we're almost evolving into a rental market that's so well served that it's like, let's call rent a credit product. If you go get a mortgage and your credit score is below 650, you're going to pay a higher rate and you're probably going to have to put a higher down payment. And if you go get a mortgage and your credit score is 700, you're going to pay a lower rate and you might have to put a lower down payment. The renting is no different. If you, unfortunately, I wish it was, but this is just how the market's evolving. So if you want to go get one of those condo units, it's actually really hard to convince a mom and pop landlord to take somebody with a sub 650 credit score, and maybe they don't want to they only want to put first and last down, because that's a lot of risk for a landlord that holds one single unit. For a purposeful rental landlord, that's not a ton of risk, and they also insure away a lot of this risk, and so they're able to take those people. And so one of the conversations that we're starting to see happen with a lot of tenants is, hey, look, your credit isn't where the regular kind of mom and pop supply market wants it to be, but there is this option for you in the purpose-built rental space, and very similar to the way it would be in credit, you unfortunately have to pay a little bit of a higher rate, and you might have to put a little bit of a bigger deposit down, but it means you get a unit. So that's an interesting kind of contrast that we're seeing with rents compared to the credit market.
Got a
Um,
question here.
yeah,
What's the difference between rentals and the purpose-built buildings?
nothing. Purpose-built rental is just like a building that was built recently with the intention of just being a rental building. Um, but your rental, so when I say like rentals, I would probably be talking about the whole market, which would include those purpose-built rental buildings. So like an apartment building, it would include um, new ones that were built recently, and then it would include your older apartment buildings, from the 70s, 80s, 60s, whatever. And it would also include condos or single family residential or, your sort of like real estate investor stock. Does that make sense?
Yep,
Cool.
that's everything.
Cool. The next piece that we saw is that rent growth increased for non-turnover units. So, and this is in the Montreal CMA, but I found this interesting. Montreal has like a very dynamic way of allowing people to price turnover units. It's based on like a almost like a CPI for landlords, based on the type of heating that they use and a couple of other factors. And turnover units are actually falling in their price year over year, or sorry, in their rent growth year over year, whereas non-turnover units are actually seeing an increase. So this is one of the few markets that sort of buck the trend a little bit. Um, Another release from CMHC recently that really caught my eye was the fact that they are putting a lot of pressure on municipalities. I mean, I've been doing this for a long time, and I'm not saying that to toot my horn. I'm saying it because it's been a problem for a really long time. Like 2 years ago, when everyone was like, why isn't anyone buying condos, or why aren't we building anything? Why aren't builders contemplating projects? Why aren't builders in Toronto, as an example, pivoting to purpose-built rental? This chart answers your question. Why is nobody building purpose-built rental in the GTA? Well, it's because the GTA has the highest development charges. Toronto, if you want to build an apartment unit, whether it's a condo or a rental, $130,000 is going to the city of Toronto. That's $130,000 that could have stayed in the buyer's pocket or stayed in the developer's pocket, which allows them to reduce rents. And so CMHC, I mean, 2026 is very much, from my perspective, going to be the year of the first time buyer, because the first time buyers have a lot of incentives that have been given to them. But purpose-built rental has been the same. So we've seen HST at a federal, or GS, whatever it is, a GST at a federal level, um, removed for purpose-built rental projects and first-time buyers. That's it. Nobody else. And then at a provincial level, the same thing happened in province of Ontario, and other provinces are kind of shuffling around to try and have similar things happen. So two of your biggest pieces of the cost structure have been removed for these purpose-built rental and first-time buyers. So there's a huge subsidy for rental developers relative to condo, and for first-time buyers relative to other buyers that they might be competing with, upsizers, downsizers, people who've already owned a house.
Got another question here.
Yeah.
What's the current vacancy rate for rentals in Toronto?
Um, I want to say, I think it was 3.7%. I can pull it up. If you just Google the CMHC, let me just see if I can pull this up here while we're on. I think it was 3.7 for purpose-built rental. I think it's sub 2% for, let's see, GTA, 3% for purpose-built rental, 1% for condos. Mhm. Now, I will say that that's a number that I expect to go up significantly still. We still have I'll show you some charts, but we still have a huge flood of condo supply coming on the market next year, which I mentioned. Like, I think we'll see as many condos close in 26 as we did in 27 or 25, 27, 28, 29. I have a chart in it at the end here, but that's when you start to see things taper off. And then rental across the country is ramping up as well. And so people are actually just starting to move around out of areas where it's too expensive to rent. Same chart, but basically for single family detached, $180,000 in the city of Toronto for development charges on a purpose-built rental, way above the rest of the country. So this should just give you an understanding of why developers are disincentivized to bring things to market. Pivoting over a little bit to the population growth side. So we talked a bunch about supply and what's happening there. I want to talk about the population growth side of the equation. And so this is a chart from Ben Rabideau, who I would encourage you to check out if you're a real estate professional. You can get his product, Edge Analytics. I think if you use the code, I want to say it's OG30, you can get 30% off. And that's available for anyone on the call. Just text me if you want it, but just Google Edge Analytics. But basically, the Bank of Canada was actually the first person or first group to publish this chart, and then Ben just kind of kept updating it since they did. But it basically shows rent inflation beside the non-permanent resident growth. And so non-permanent residents are like guaranteed renters, right? They're not permanent. So like why would they buy a house? So if your non-permanent residence number is high, then your rents are going to grow with it. And so we saw rents skyrocket with non-permanent residence growth. Now you're seeing that curve come down to the point where it's actually now below, way below zero. So your net non-permanent residence is about negative 127,000, I think it was the number. This is Ontario. This is Canada. So 167,000 in Canada. And this is going to have a major impact, obviously, on our rent inflation and potential rent growth. I know Ben Tao put out a report that there's a lot of like shadow demand where there's a lot of like people our age who maybe are living with their parents or being roommates or whatever, and they might consider as they start seeing rents fall, they might go out and start scooping up units, and that's true. But the problem is that's not a huge rush of supply like non-permanent residences. That's like a slow trickle, or sorry, a huge rush of demand. It's a slow trickle of demand, right? People, you maybe get a couple hundred or 1,000 people a month who say, "Hey, rents are really cheap." Maybe they say their partner, "Hey, we should move in together." Like the classic reason why people would do new household formation, and they go and rent a place, or people are. It's Christmas and they're like, I don't want to live in my parents' house anymore, and they move out in January or February because they can now find a unit that's affordable. That's true, and that'll happen, but it's going to be a lot slower than this huge rush of, you know, 1.5 million people over 3 years moving to Canada that are international students and temporary foreign workers. Did
Um,
you get another question there?
yep, we got a couple here. First one is, with so much downward pressure on rents for condo units and apartments, what do spillover effects look like for single family home rents?
Same thing. I mean, you're gonna see like you'll see the a trickle, right? So basically, if people are, it's a little different for single family homes because they're sort of on a class of their own. But like if I'm renting a 3 bedroom bungalow in Mimico or I don't know, like wherever, anywhere, and I say, return to office is happening. I don't want to be so far from downtown, and I can go get a 3 bedroom condo. If I'm renting a 3 bedroom detached for 4 grand, and I can go get a 3 bedroom condo now for 3 grand, and the economics make more sense, then again, you just have to think about it in the way of like, what would like people's exchange products be? So if somebody's thinking, okay, I'm going to switch from a 3 bedroom house to a 3 bedroom condo, then that's pulling that demand away. And then that unit might have to reprice to compete with the demand that it's losing to those other units. So there can be a little bit of downward pressure. And the same thing happens sort of in like in prices from what's you would call like a wealth effect. But the other piece of the puzzle, and I showed this in one of the last reports, was we're not building very much single family detached. And so the relative value of a detached rental, because like detached rental landlords are going extinct because unless you've owned it for a long time, they don't economize. And so nobody's buying them to turn them into rentals now. People are buying them to, you know, make them triplexes or multiplexes or whatever. So they'll become more, single family rentals will become more scarce. So they'll probably go through a short period of turbulence where like they could get pulled down by condo and purpose-built rental rents, but then they'll probably be sooner to recover because they're just way more scarce and more coveted, right? If you ask most Canadians, what do they want to live in? Does most Canadians want to live in a high-rise apartment building? No, they do, and they choose to, and you would think that based on the fact that 70% of people live in an urban area, but it's actually a money thing. Most people do want a house with a yard and all those things. They just can't afford it, right? So that's kind of the interesting piece of the puzzle there. Was there any other questions there?
Yep. This one is, are these new rental apartments larger in square foot compared to the new condos listed for rent, making it easier to rent for longer periods of time and raise a family?
Yes and no. But generally, yes. I would say generally they're a little bit larger. Like if you're building purpose-built rental, they are slightly larger than your condos on average, but the condo average gets skewed down by the bottom end, like the lower percentile of condos. So most condo builders were building a ton of like hotel room sized condos. Maybe that's like a little bit of an overstatement, but like, 3, 4, 500 square foot studio and like 1 bedroom. that pulled like the majority of their supply would have been that. So that would have pulled your average down a lot. And the reason they did that is because they were chasing what's the lowest sticker price I can put on this unit. So when somebody looks at a price list, they go to the bottom and they say, that's the one I want because it's the cheapest. They don't have to do that with rentals as much because they're not trying to sell the units off. So we are seeing a little bit just from that incentive alone of builders basically building what's going to be the most economical unit. And that's why you're actually seeing a lot more two bedrooms and even three bedrooms because a two bedroom is often becoming a roommate household. A three bedroom is often becoming a roommate household. And so that's actually a dual income household. Even if like, I mean, a studio, you couldn't really consider a dual income household, even if the people shared a bed, like, cause I don't see a couple being able to live comfortably in a studio unless they spend no time there and basically do use it as a hotel room and like eat out every night and never spend any time in the unit. And so when you think about like your floor on prices as well, you want to think about those studios as a single income. What price would they have to fall for a single income Torontonian or Vancouverite or whatever to buy those units? Um, and you want to think the same way on rents as well. But generally, yes, the units are larger in the rental buildings than condo buildings. Is that it?
Yep.
Okay. Another interesting note, and not a lot of people are talking about this data point from the Q3 release from StatCan. Um, Ontario actually saw a um, record level of people leaving, Canadians leaving. This isn't just so the chart that I just showed you was not Canadians, it's non-permanent residents and permanent residents. So the permanent residence is in blue, so that number is actually still growing, but your non-permanent residence is in red, and that's negative. So that's people who are not citizens of Canada, right? They're permanent residents or net or non-permanent residents. That number is below zero. But the number of people leaving Canada that are Canadian citizens is also at a record high. It's not a huge number. It's like 20,000 people, right? It's like it's a rounding error when you think about it in terms of like 167,000 people or the size of the Canadian population, but it's still there. And I think this is an important thing because I want people to pay attention to that uptrend that we're seeing. Like you look at historic cycles, you can see the peaks and valleys. You know, people tend to migrate at certain times of the year, but that like the last 4 years, you've seen higher highs, and this tells me that more Canadians are choosing to leave Canada. And I think it's really important that we try and think about why that might happen. I'll let you draw your own conclusions. I won't conspiratize too much on it, but I think that, you know, it would tell you something about whether or not people, Canadians, as well as non-permanent residents or people immigrating to Canada, whether or not Canadians are satisfied with the economic promise of Canada. Same
Just
thing is happening. Yeah, go ahead.
a good question come in. What is drawing people to leave Canada? What are the destinations that they're going to?
Hmm. Yeah, so the problem with this is we don't have a ton of like recent data. Um, but you could argue that you could probably use past data. This past data might have changed a little bit with like Trump and tariffs and stuff because a lot of the people who would have been immigrants before, maybe are older people, like the boomers, like kind of liberal vote, like the sort of anti-Trump sentiment that we're seeing, probably aren't going to the U.S. But maybe they're going to Europe or something like that. But by and large, I mean, I think that that's one portion of the economy, and then the other portion of the economy is more your conservative, your people who like what the U.S. is doing and see more economic promise there. And so you're seeing a lot of people moving to the U.S., a lot of younger people, kind of prime tax paying years, um, you know, entrepreneurs, people who can afford to move to the US, who do see economic promise in the US, who can afford to take that risk of restarting their economic life in a different country. I would say that those are high quality people that you want to keep, right? And so that to me is concerning that you're seeing those folks leave. And the ones that aren't leaving or at least aren't going to the US, maybe they're going to a different country now because they want to stick it to Trump is, you know, sort of your older generations that you know, from voting patterns would illustrate that they're primarily liberal voters and not happy with what's happening in the U.S. But CBC, let me just see if I can find the name of the article here. CBC, if I pull this on top, can you just see that? If I just
Yep.
okay, cool, nice. That's very convenient. Um, yeah, so CBC put this article out here that shows emigration from Canada to the U.S. hit a 10-year high. This was in 2022 data, right? So again, I would caveat that very subject to change based on new political regime they have, et cetera, tariffs. But 70% increase from 10 years prior. And if you look at the number of Canadian immigrants to the U.S. by place of birth, and just look at the red bar here, this is born in Canada. It hit a record high in 2022. I would say that that number probably has continued growing. We just don't have fresh data. This data comes from the U.S. Census Bureau. I actually tried to pull it yesterday, and they still don't have data for and their government. Ironically, based on this conversation, their government shutdown has made it super unhelpful to try and get data right now. Even though they're back up and running, it's still everything's lagging, right? So, and then you can see the top countries where Canadians have emigrated, and this is a 2020 data point, but and this is the wild part because it goes by female versus male, and it's actually massively biased towards more females moving to the U.S. than males. And that's again 2020 data point. So this is just the most recent reading that we have. This article from CBC came out in 2024, actually on my birthday, May 30th. But so you can just Google that headline and you'll be able to see it. I expect you all to write down my birthday so you can send me a text.
And
Anyway,
just
so
another
yeah, go ahead.
question on that topic.
Yeah.
On the topic of people leaving Canada, is house prices a main secondary or tertiary factor, or is it employment?
It's a little bit of both, right? So affordability is tricky. House prices would be like the biggest place that people feel an affordability crisis because it's the largest portion of household income. So when I think about affordability, like I could literally still be in the GTA and cut my rent by 50% if I moved to Niagara Falls, New York. You know what I mean? Like not actually, but like and take a jet ski to Toronto. I'm joking, but like hypothetically, I would be like in this if I could move to like Coburg or Niagara Falls, New York, or Buffalo, New York, and have a comparable commute to like the exurbs or like further suburbs of the GTA. So like some people think about it like that, right? It's just purely price. What's the cost of buying? What's the cost of renting? Now, the cost of buying in the U.S. is actually not good. It's actually the worst it's ever been comparable to renting because interest rates are so high and prices are so high in the U.S. They haven't really started to come down yet. They've just started rolling over. Certain areas you're seeing big drops. But so I think housing affordability is a primary one. Inflation is obviously another primary one. Like people, and especially this time of year, food. Like I don't know if you saw the one thing that stood out to me from the most recent inflation reading from Statistics Canada. Food inflation is at 4.3%. Everything else was like pretty standard. Food inflation is up 4.3%. So it was double what the inflation of everything else was. Everybody's going to be going to the grocery store, buying their Christmas dinners, doing this entertaining, and saying, "Damn, I cannot afford to live in this country anymore." And I feel that way. And like, and wealthy people that I talk to are saying, "I don't know how regular people are surviving." And the answer to the question I'm going to get to later in the report is they're taking on more debt. I'm actually going to get to it like immediately because it's my next couple of slides. But yeah, so I think affordability is a key piece. I think it's just funny because and I don't mean this to be disrespectful, but it's going to sound disrespectful, so whatever. People who can't win in certain places, maybe win's the wrong word, but like people who can't succeed in Canada and want to blame Canada for their lack of success aren't going to win in a more competitive economy like the US. And so a lot of people actually move to the US and actually experience a lower quality of life, and they think that there's more economic promise. But it wasn't actually Canada, right? We love to blame, like especially Canadians, we love to blame. We don't take a lot of personal accountability, and it's because we are politically a more liberal country. We think that there's like this big entity of togetherness that is responsible for our success, but in the U.S., there's very much this principle, more like the conservative leaning of individual accountability and responsibility. There's a political term for it, and it's a principle of conservatism. And so there's kind of a bias towards people who can't take accountability for their own success or failures and actually not winning in or not having the same level of success in certain countries. So I think that part's always interesting, right? It's like I'm going there for cheaper housing or whatever, but it actually isn't going to solve my problems. The last piece that I'll mention when we talk about affordability is wages, right? So you have to be able to go and earn more money in another country, and that's probably the biggest place where the U.S. just completely blows Canada to bits. The wage upside that you have in any career in the U.S., almost any career, and one of the reasons when we looked at that data point where it was mostly females moving to the U.S. in the CBC article here, a lot of that is like traveling nurses, traveling people in the traveling healthcare profession, because that's one of the easiest places for people to get a visa. And there, I want to say I spoke to somebody just doing like a Twitter space or something about this, and they were saying like their wage was like double, if not almost triple, as being like a traveling nurse in the U.S. versus Canada. So things like that are I think where policymakers really need to be paying a lot more attention. Canada has built a model basically where we like tech companies like to invest in Canada because and start uh, offices in Canada because we have super cheap wages and they get the US dollar. But now we're kind of getting to the end of that the song is ending and Canadians are saying, look, we can't nobody can survive right now. And that's I think the bigger reason is there's more economic promise in the US. Unemployment rate is lower, wages are higher, wage growth is better. It's not I don't so I think affordability is a big portion, but affordability relative to how much I can make, right?
You took the words right out of my mouth. I was just going to say, my boyfriend works for a tech company here in St. John's, and it was acquired by a US company back in 2021. And I've always, a 600 person company, I've always
Mhm.
said the reason why a New York company would buy a 600 person company in St. John's is because they can pay people about half of what they would be paying people in New York.
Literally. Yeah. Yeah. When you count for like Canadian US dollar exchange and just the lower wages and that's like not even just small places like no offense to St. John's, but like not a small market like Atlantic Canada, et cetera. But like even in like a big city like Toronto, where cost of living is insanely high, you can still pay people exceptionally low wages for same quality of work that they could do in the US. And this is why Canada exports talent, right? Like we export most of our best Waterloo grads go to Silicon Valley. They don't stay in Ontario to build up companies here because our wage growth is just not sufficient. Okay. On that note, when we talk about young people and young people chasing wages, we're seeing a lot of interprovincial migration in Canada. And basically, the big story here is, I mean, most provinces kind of nominal, small changes. Ontario, 2 years back to back of huge drops in population, and Alberta, 2 years back to back of huge increases in population. And this is people under 25. Ontario is not as bad as it was last year. It's actually about half as bad as it was last year. And Alberta is coming down a little bit in how many people are moving there. So that would tell me Alberta is getting a little bit expensive. Ontario is getting a little bit cheaper. Maybe people are kind of slowing down on that pattern. But, by and large, the big story here is Canada is very much a story of people leaving Ontario or people leaving everywhere and people going to Alberta. Is that going to continue indefinitely? I don't know. Honestly, I really have no clue. But I would say I think eventually it'll kind of normalize. No offense to Alberta, but like a lot of people want to live there. Not everybody wants to live there, right? The debt side of things, also in Ontario and BC story, prairies have all kind of come down quite a bit, but Ontario and BC and then Atlantic Canada as well. I'm starting to see a huge increase in non-mortgage debt per consumer. I'm going to blow through a couple of these because I'm getting a little bit short on time. Total consumer debt just hit a record level in Canada, 2.62 trillion, 3.4% up year over year. Delinquencies are rising, though historically low, and you can see we're at about we're kind of past that kind of peak that we saw in end of 2024. It looks like it probably will climb back above that again, but we're sort of at like 20 Q2 2020 levels. So like sort of pre-COVID levels. We're kind of getting past that wave of lenders and the government fixing problems for people. 90-day delinquencies rose in all debt categories except for auto loans. And auto loans, they were slightly down. Ontario and Alberta, again, continue to stand out with high delinquency levels. Q3 2025, they both hit a record high, a record jump, not a record high level. Let's jump here. Consumer insolvencies, so people, not corporations, but people, individuals going bankrupt, was falling for 4 quarters in a row. This was a good sign. Like this was a data point that I was saying, wow, like maybe we're past the curve, and it just spiked, and it spiked in a big way again for both bankruptcy and consumer proposal. The key thing to see here, consumer proposal is kind of whatever. I mean, for those of you who have gone down any of these roads, consumer proposal is basically where you like negotiate with your creditors to get a reduced, you propose some sort of way out. Bankruptcy is where you just say, I cannot do any of it. I'm writing this all off. I'm going to kill my credit for 7 years. And I'm just like, take the house, take the car, take whatever. I'm starting from scratch. Bankruptcy, The more violent way of going about this is the highest that it's been on this data set here. That's a scary one. I put this tweet out here. This is I literally screenshotted right from this chart, and this is like people accuse me of like stop giving people false hope and whatever. But first time buyers are starting to return to the market, and I would actually say that like this isn't really me trying to be like bullish or give people hope. It's actually I think it's interesting because first time home buyers are like logically the most likely to start the knife catching contest of a falling real estate market in Canada, right? So you got the knives falling and who's going to reach out and try and catch them and willing to take that risk. A young person who is young and can bounce back from getting their hand sliced on that knife way faster than anyone else in the market. Why can they do this? Because they've never tried knife catching before. So they are like, how hard can it really be, right? They've never seen a cycle. They are young. They have been excluded from any knife related games for the past 5 years. And so they say, I want to go play in this game, right? Maybe I'll stop using the analogy of knife catching now, but they are the ones who felt marginalized out of the housing industry or housing market for the last 5 years. And so they're saying, this might be my last chance. They give themselves the FOMO. And so I think when I look at like first time home buyers, that the one piece that I don't like about this is that they show the average residential price shows signs of stabilization at a national level. I would say that that could be true, but the interesting part here, and I drew a line on this, is the average loan amount that first time buyers is taking is almost back at record levels that we saw in at the peak of the market. So first time buyers are coming back in the market in a big way when it comes to how much money they're putting on the line. The volume of first time buyers buying in the market is up massively across the country. Alberta is actually the lowest growth in first time buyers on a year over year basis. That would mean that they were probably from a high base, right? So that if last year it was a really high number, then didn't have to grow that much to continue still being a big number. But 20% increase in Ontario, almost a 30% increase in BC, Saskatchewan, 35% increase. First time buyers are the ones really driving the market, and they're probably going to continue to do that as the policy environment really starts favoring them. And again, they're I think they can afford to take the risk because they're thinking this is my house for 5, 10, 15 years. I'm going to live here. I'm going to service my mortgage. It's cheaper than renting, blah, blah, blah. Like they have so many incentives that align with having the willingness to take the risk. It's not me trying to say that first time buyers are rushing into the market and we're going to see a flood of demand and it's going to push the market up because I don't think that's the case. But I think that it's logical to assume that they will be re-entering the market and continue to do so through 2026.
When it comes to first-time buyers, I know a big story of the peak of the market there a couple of years ago was first-time home buyers getting these huge windfalls from the bank of
Yeah.
mom and dad, like six figures. Like, is that still a big part of the story for first-time home buyers?
Yeah, it is. If you go to CMHC's mortgage consumer survey, um, in whatever the most recent one that they put out, mortgage consumer survey, May 21st, 2025. Um, where are we here? 54% of first time buyers shared their home purchase with someone other than their partner or spouse. So that's a cosigner, parent, whatever. There's another one in there where sources of down payment, 41% use gifts or inheritance. Okay. So a massive portion of our buyer pool is getting money from the bank of mom and dad and a cosign from the guarantor of mom and dad. So to me, an interesting and bad byproduct of the stress test, by the way, because they might have been able to go and get a mortgage if they weren't being stress tested at 200 basis points higher than their qualifying rate, but now they are. And so they need to get the cosign from mom and dad, or they need more equity in the deal to buy down to get them into a different mortgage category. This creates a bit more of systemic risk, right? Or maybe contagion. So now all of a sudden, if these buyers who are, no offense to them, the highest risk borrowers in the market, they have the lowest equity in the deal. Most of them are negative equity. They have the most exposure to unemployment because they're in entry level careers. And they're the least experienced buyers. So they have the highest likelihood to overpay for a product. If they go delinquent, now mom and dad, it's going to impact their credit file. Or if they lose equity, now mom and dad are the ones losing money. And this is where the contagion, I think, actually creates more stress in the market than the stress test intended. So there was two ugly byproducts of the stress test. One I've highlighted a bunch of times, which is that it pushed a bunch of people into the variable rates right before the Bank of Canada hiked rates. And two is that it created a little bit of systemic or contagious exposure to the bank of mom and dad. Any other questions there?
No, we did have an interesting comment. Someone said, it is true about first-time home buyers. I just closed a few that were priced out.
Hmm. It's huge. Yeah. I think, again, like they see prices coming down, they see rates coming down, they say, I can afford a house again. And rather than saying, is it the best time for me to buy it? They're just saying, I need to buy it. Right. And I'm not going to take that right away from them. Right. Like I try and exercise the idea of like doing the math with people, et cetera. But a lot of people have done the math and it does make more sense to them. And so they're doing it. I'm going to blow through the rest of these charts because I'm already over time. But delinquency rates, hugest increases in Ontario and BC shouldn't be surprising. That's where people had to take on the most debt. Continue to climb in both markets. This is what the charts look like on a historic. So, and I would say that they're not coming down anytime soon. Biggest mortgages are going delinquent the fastest. I've already presented this in Equifax's most recent reports, but it shouldn't surprise people. But then you also think, well, people who can get big mortgages should have higher incomes, more equity, et cetera. And yet they are going delinquent the fastest. So this is like, you think it's like your kind of like lower end of the market, right? You think it's like your regular borrowers who are the ones at risk, but it's actually your more luxurious, like higher end, more expensive properties that are the bigger the mortgage, the bigger they are, the harder they fall. I guess is the easiest way to put it. The other interesting piece is delinquencies based on we call it like a vintage, but like when those delinquencies or sorry when those mortgages were first written, and your 22, 23, and 24 mortgages were breaking the trend, especially for Ontario and BC, but they were outpacing, they were going delinquent faster than any other mortgages. 2025 is the first time where we've kind of actually, if you can see this 2025 line here, it's that like light blue line in the middle there, both Ontario and BC and at a national level, they're actually going to delinquent less than their previous years, which is a good thing, by the way. Like we're finally at the point where people are taking on mortgages and not going delinquent faster than the pace that they should be. Um, this is just mortgage renewal side. I'll go. I'm just going to quickly go through this one, but basically, 2026, we're going to see the most mortgages renew. 30% of all mortgages will renew. Bank of Canada has done some research on this. This comes from the Bank of Canada website. If you just search mortgage renewal wall, Bank of Canada, they show projected rate paths based on what the financial markets are looking at. So they see the Bank of Canada continuing to cut a little bit based on this forecast was like kind of middle of the year. So probably have a couple of these cuts in here, but they actually see the bond yields, 2-year and 5-year Canada bond yields actually rising. And like that line's pretty steep, right? So your 5-year Canada bond yield is expected to rise into the mid threes, 2-year to around 3%. These are your fixed rates, right? So your green is your variable rate plus whatever the spread is. And then same thing on the blue and the yellow. When I think about CMHC, all of those rental projects that I was mentioning earlier on, they're on those blue and yellow lines, on the blue line actually, and then your buyers are either on the blue line or the green line. So this is probably your biggest headwind for purchasing power. And if rates do continue to rise in that way, and why do they think that that might happen? Is because the government's going to be spending a ton of money. That's inflationary, and it also means that bond traders can basically charge the government as much as they want for from a yield perspective, because the government's going to be basically issuing a ton of bonds, taking on a ton of debt. So if I'm a lender and I have a hot product and you know everybody wants money from me, I can charge them whatever I want. The government's kind of the same way. The Bank of Canada's research showed that about 1/3 of all of the mortgage holders are likely to see payment increases by the end of 2026. So it's actually not a huge portion of people that are going to see an increase in payment. And most people who are going to see an increase in payment are next year, 30 or 2026, 33%, or a third of all of them. About 23% will see a decrease, and then 42% will actually see no change in payment. So it's not as bad as it once was. It was really scary when rates were super high and everybody was at a 2% rate and we're looking at renewing at a 6% rate. That's not the case anymore. And they kind of break down the mortgage products that where people are going to see potential risk. And the biggest group cohort of people is with mortgages with a payment increase is your fixed term with 5% rate. So basically all of your buyers from 2021. And this is where it does get scary because even though it's a small portion of the total market, this is the highest risk portion of the total market. So I do think that we still have another year worth of distressed supply that could come on the market as a result of those products. Because these are people who bought in 2021, they paid top of the market prices, they bought with the cheapest interest rates ever, and the economy's been a mess and inflation scenario has been a mess since then. So these are buyers who are most likely to experience severe financial stress as a result of that renewal. A lot of that product is probably going to say most people, especially if you're on a fixed and you have a buyout on your mortgage, you're most likely to sell your property when you're up for renewal. So I do think that we will see, I think that there's a way higher likelihood that we have pent up supply in the market right now across Canada than there is pent up demand. We might have some pent up demand. I don't think it's anywhere near to how much pent up supply could hit the market in 2026. So that's the one thing I would say is if I'm an agent looking for as much business as I can get, I would be probably focusing more on sellers than buyers. And I know listings are really tough to move in this market, but sellers who are in positions of financial stress, they need your help, right? They need to get out of the asset. They need to right size. They need to sell their property, reduce their debt load, maybe go buy another property with a lower mortgage or rent for a couple of years and rebuild their credit or whatever it is. But there's a lot more urgency on the sell side than the buy side right now. This is just a distribution of what rates are going to renew. I won't try and explain this chart because I don't have enough time. I'm already way over, and I appreciate all of those of you who've stuck around in this. Appreciate the holiday spirit. This is probably the most important chart from Equifax's entire debt thing, and I could probably just skip the rest of them to be honest with you after this. Um, it says consumers who see large payment increases at mortgage renewal point are more likely to miss payments on their credit card and personal loans. So when you think about those people that I just mentioned who are going to see an increase in mortgage payments, they're not going to stop paying their mortgage first, right? The smart ones will sell. They'll say, we can't afford this. It's not sustainable. We got to sell the house. Let's reconfigure it and we'll figure it out in 2 years. Market's not going up or down anyway, so who cares? You but the people who are going to go delinquent, they're not going to go delinquent on their mortgage first. They're first going to stop paying their credit cards, and then they're going to stop paying their personal loans, and then they're going to stop paying their auto loans. And you kind of go down the list of like, what are the things that are necessary to my life? Okay, I can live without a credit card. I can live without a line of credit. I can kind of live without a car. Maybe we can stop paying one car payment, and then it's my house, right? And so going down that, it's on like The Big Short, right? It's going down that like hierarchy of needs of the tranches of debt that people consume. This is where you really want to pay attention to. If we keep seeing credit card products for people with mortgages, credit cards, auto loans, et cetera, continue to climb, that would, until those roll over, that would tell me that more people who own houses are going into financial stress, and eventually they hit a limit, right? Eventually their bank says, hey, CIBC just called me and said that you stopped paying your car loan. What's going on? We got to talk about this, right? This is where I think that if you want to pay attention to any data point in 2025 or 2026, this is the one. Um, anyway, that's just a summary of those two charts. I'm just going to skip the housing market honestly because it was a lot more of the same. And I'm out of time. Price velocity kind of hit a new low a little bit. You can see here that we're sort of still below the line, so prices aren't growing. Um, um, Korea hasn't properly put out their stats yet, so I didn't update these with November data. I tweeted at them this morning to tell them because I was trying to prep for this, but so I don't have November data, but it would be basically the same thing. Your November would be just below your 2024 line. So we're a little bit below last year. October a little bit below last year for number of sales and total dollar volume traded. Not as bad as your 22 and 23, which were our real blow off years from the credit cycle. And then supply is similar. Supply is actually down year over year in November. So we are seeing supply actually slowing. And again, that could be pent up supply. It could be people saying I'm maybe pushing it to the spring. I don't know. We'll find out in the spring. I think the spring market is going to be very, very deciding for Canadian real estate. And months of inventory is relatively standard. The last two charts here, three charts. A lot of people have mentioned to me this GTA, and this thanks to Trevor for sending me this, but GTHA condo completion. So this is from Urbanation, 30,000 last year, 30,000 the year before, 20,000 this year. Again, I think that this number is probably going to drop to 25 or maybe even less, and this number will go up by the equivalent amount because builders are more incentivized to push stuff into 2026. So I think we have 3 years back to back of basically record supply being delivered. this is what that ends up looking like. This is from CMHC, also from Urbanation. Um, this is a record number of months of supply of pre-construction condo apartments. Obviously, a lot of those pre-con's easy. You can just take those off the market and cancel the project, which is what we're seeing. But the one way I want you to think about this is we often compare present day to the 1990s. And the I didn't realize this, and I'm pretty bearish, and so I thought I would have really tried to push for a comparison. But the 1990s, the supply in the 1990s, and this is at a national level. So Toronto and Vancouver, I would say, isolated incidences where the curve would probably look very similar to present day. But at a national level, our market is not nearly as oversupplied as it was. In fact, we have fewer completed and unabsorbed dwellings than we did during like 2012, during the global financial crisis, and especially during the 1990s. So from an oversupply perspective, I actually from a new build, I don't know if we're actually at that much risk. Now, a lot of this is getting skewed down by the fact that a lot of pre-con units are pre-purchased, so they're not technically unabsorbed, and then a lot of stuff under construction is also rental stock. But all of that being said, I don't know if we're going to see this like next catastrophic down leg. Precon's already been absolutely decimated. I mean, you're basically your precon markets or your resale markets trading at like 850 to 900 a foot. Your precons before were trading at like 1500 a foot. I mean, I don't have to. It's not rocket science to explain the catastrophe that's involved with that spread. And you're starting to see precon markets actually blow out inventory at prices below the resale clearing price in the market. So this repricing that's taking place in the pre-con space is going to be violent. But I think that the more violent that it is, the more that it's going to, I guess, the more that it's going to speed up the process of getting all of those units absorbed. So you should actually be wishing for maybe like I don't want to say the worst possible, but like we can't avoid the pain. There's no sense in prolonging it, right? It's like if your leg's broken, do you want to get surgery right away? You know, it's smashed and you got to get, it's like, do you want to get surgery right away or do you want to put a cast on and leave it for like 6 months because that's how long it's going to take because it's that bad of a break? This is the point. Like we're in triage right now where we have to decide as a country, do we want to get rid of the pain and experience it as badly as possible and then solve it, or do we want to keep prolonging it and it actually ends up being worse and could potentially cause worse problems down the road? So lots of excitement for 2026. But I do think that again, like I think from just my general summaries, and we'll get to questions, is volume is going to continue improving, which is a good thing for the Canadian real estate industry, for real estate professionals. Prices probably won't continue improving, but prices coming down will help us sell more houses because more people can afford them. The biggest things are going to be running the math for people, especially first time buyers, on what the cost is, and then also helping people through the very scary market that we're in, which is I don't know if I'm gonna have a job. And so I think once we get past sort of like that, like trade war, et cetera, things could improve. And that the trade agreement's up for renewal next year. As long as that doesn't end completely catastrophically, I think things will start clearing up after that. It could end pretty catastrophically though.
Okay.
All right.
Well, it looks like some folks are starting to trickle out, and we don't have any active questions open. So I think if that's everybody that everybody had, I think that we're ready to go. And
Cool.
oh, actually, we did have one last minute
Sure.
comment. I heard that prices will climb across Canada by about 1 to 2% in 2026, but remain lower than in 2022. 2022, is that true?
I mean, who knows? Like, I try not to get in the business of forecasting, but I would guess that prices would not rise next year, mostly because prices are still falling in Ontario and sort of in BC. And those two markets skew the national average massively because they have the highest prices and the most volume. And so I think it would surprise me to see prices increase. And I mean, will they increase in a lot of markets? Yeah, Ottawa's increasing, Calgary's still somehow increasing, kind of rolling over, but let's see. Atlantic Canada caught a bottom when people could start to afford houses again. I mean, you go out to where you are in Newfoundland, and prices are up like 12% year over year, right? But it doesn't those and Korea puts out a chart on it, and it shows the increases country by country or province by province. I think I had it in the deck, but so people can go through it or just go to stats.korea.ca. But the like St. John's or Newfoundland has like, I don't know, maybe like 1,000 houses sell. The GTA has whatever 10,000. So or what whatever the number is, 50,000, 60,000, 70,000, whatever. So that's way more data. Like it doesn't even matter what happens in a lot of other places. No offense to those places, but like it's just the GTA will always skew, or Ontario will always skew the data. And I think Ontario, maybe not all of Ontario, but the GTA is continuing to fall, and that'll pull the national average down. That would be my guess.
Just one more question came in. What's the average price for a pre-con now?
Uh, I don't know, like price, no idea. To be honest with you, there's so much variance in the units. Price per square foot. I've seen projects blow out. Okay, so let's unpack this. Precon doesn't exist right now. I'll be honest with you. Like there's, I mean, there's one project that's launched successfully in the GTA, and it launched at like 675 a foot. There was maybe another one a year prior that launched at like 1,100 a foot. So whatever is the middle of that. Um, the inventory is now your kind of like new precon. They're units that are about to close. People are trying to builders are trying to blow out like you know two or 20% of their units, whatever the failed units that failed to close and all the units that they held back. And they're selling those at similar prices, right? 675 seems to be like a sweet spot for what builders are blowing supply out in the GTA at right now. So on a per square foot basis, that might be your answer to the question, which is like, it makes me want to barf that that's the answer to the question. So I would not use that number per se. I would just probably price it where the resale market is, which is 850, depends on where you are. 416, like maybe low nines, maybe high eights. If you go out to the 905, depending which market in the 905, you're getting into the eights. Go out to like, even further, you start looking at high sevens. So I would say that's if I was gonna say where precon would end up trying to launch in the next couple of years, it's going to be way closer to the resale market. Like just and the easy way to think about this is like before the craze of COVID and all of that, like precon sold at like 5 or 10% above the resale market. And then price acceleration went crazy. Builders are trying to capture the spread. Contractors were charging insane amounts of money. Speculators were paying insane amounts of money. And so we got to like 20, 30% over the resale market. Now that spread's just gonna tighten. Precon will just stop being, it'll go back to 5% above the resale market. And the benefit is that you pay a little bit of a premium, but you get a brand new unit and maybe, in a better location, new project, whatever. So it's a very tough question to answer because precon barely exists right now.
Hmm. Yeah.
Yeah.
Okay, well, that looks like everything.
Okay. Awesome. Thanks a lot. I really appreciate it. Thank you everyone for enduring my stupid outfit, and Merry Christmas and Happy New Year to everybody.
Merry Christmas. We'll be back on January 27th.
Awesome. Looking forward to it.
See you then.